What if the greatest financial secret of our generation isn't hidden inside a high-frequency trading algorithm? Or a secret meeting in a Wall Street skyscraper? What if the stocks that could double, triple, or even multiply your life savings by 10 times are sitting right in front of your eyes, at your local grocery store, in your kid's favorite video game, or inside that boring box of detergent you buy every single month? Most people believe that to make real money in the stock market, you need an Ivy League degree, a screen full of moving averages, and a deep understanding of complex financial derivatives. But back in the late 1970s, one man proved that the entire financial establishment was looking at wealth completely backward. His name was Peter Lynch, and while every genius on Wall Street was busy losing sleep over interest rates and geopolitical panics, Lynch was quietly walking through suburban shopping malls, chatting with everyday managers, and turning a simple mutual fund into an absolute legend. How did he do it? How did a guy who ignored economic forecasts manage to consistently crush the brightest minds on Wall Street? Year after year, decade after decade? The answer is simple, yet deeply unsettling to traditional finance. Peter Lynch realized that the best investments aren't hidden in complex mathematical formulas. They are hiding in plain sight, buried inside the simple, everyday routines of ordinary human beings. But here is the catch. Most people look at these companies every single day and never see the fortune sitting right behind the counter. Stay right here, because by the time this story ends, you will never look at a retail store, a restaurant, or an everyday product the same way again. Picture the late 1970s. The economy was a complete disaster. Inflation was skyrocketing, unemployment was painfully high, and the stock market was stuck in a brutal, exhausting mud pit. Wall Street analysts were terrified. They spent their days locked in air-conditioned offices, staring at economic data, panicking over oil prices, and predicting total financial ruin. Meanwhile, Peter Lynch was doing something completely unheard of for a fund manager. He wasn't sitting at a Bloomberg terminal. He was driving across America, pulling into gas stations, visiting donut shops, and walking through crowded department stores. He noticed something fascinating, something that the suits on Wall Street were completely blind to, even in the middle of a terrible recession. Certain businesses were packed with eager customers. People were still lining up in the morning to buy hot coffee. Women were still rushing to buy a brand of pantyhose packaged in colorful plastic eggs, and families were still flocking to cozy, affordable restaurants. Lynch asked himself a fundamental question that changed investment history forever. If a company's product is so irresistible that ordinary people spend their hard-earned cash on it during an economic crisis, why aren't we buying the business itself? Think about that for a second. The elite analysts were reading heavy financial reports written by corporate executives, but everyday consumers were witnessing the real-time health of these companies with their own eyes. Wall Street had the numbers, but ordinary people had the truth. This was the birth of what Lynch called observational edge, the radical idea that you, a normal person paying attention to your daily life, have a massive advantage over professional fund managers. But this raises a dangerous question. If finding great businesses is really that simple, why do most retail investors still lose money in the stock market? To understand why, we have to look inside human psychology. When the average person decides to invest, something strange happens to their brain. They suddenly stop acting like reasonable human beings. They ignore the companies they actually know, love, and use every single day. And instead, they start hunting for exotic, high-risk speculations. They buy shares in obscure biotech companies they don't understand, or chase volatile tech startups operating in industries they know nothing about. Why? Because human nature craves complexity. We are wired to believe that big money must require secret, complicated methods. Peter Lynch saw this tragic psychological flaw and exploited it masterfully. He realized that when people invest in things they don't understand, they panic at the first sign of trouble. The moment the stock price drops, fear takes over. They sell at the worst possible time because they have no real conviction in the business itself. But when you invest in a simple business, you personally understand. Your entire dynamic changes. You aren't just holding a ticker symbol on a screen. You are holding a piece of a real-world engine that collects money from real human beings every single day. Take the legendary story of how Lynch discovered one of his biggest stock market wins. It didn't start with a hot stock tip from an insider. It started when his wife brought home a pair of pantyhose sold in a supermarket called L-Eggs. Lynch didn't ignore it. He looked closer. He realized the product was cheap, high quality, convenient, and bought over and over again. The company behind it was driving incredible sales. Long before Wall Street analyst reports even realized what was happening, by the time the institutional investors finally woke up, Lynch had already locked in massive gains. Now, you might be thinking, okay, so I just buy stocks in companies that have long lines at the store. Not so fast, and this is where most people get burned. Spotting a popular product is only step one. It's the hook that catches your attention. But to separate a temporary craze from a true, long-term wealth engine, you have to look underneath the hood. You have to understand the hidden economics that make a business truly powerful. Lynch had a set of bizarre, almost counterintuitive rules for finding great businesses. In fact, the ideal company for Peter Lynch would sound like a complete nightmare to the average investor. He loved businesses that sounded boring, or better yet, completely absurd. He loved companies that operated in unglamorous, dirty, or unsexy industries. Why? Because Wall Street analysts are human, too. They want to brag at dinner parties about investing in cutting-edge tech, aerospace, or revolutionary energy. They rarely want to talk about a company that manufactures rock quarries, process waste management, or produces basic auto parts, and that emotional bias created a massive financial opportunity when a company is boring or operates in a niche that nobody pays attention to. Its stock stays cheap. Big institutional investors ignore it. The media doesn't write articles about it. The company is left alone in the dark, quietly collecting massive amounts of cash, reinvesting that cash at high rates of return, and compounding its earnings year after year. Consider this. What makes a business truly unstoppable isn't shiny marketing or hype. It's what economists call a moat, a structural advantage that prevents competitors from stealing its profits. Sometimes that moat is pricing power, the rare ability to raise prices without losing customers. Think about your morning routine. If your favorite coffee shop raises the price of your daily cup by 20 cents, do you stop drinking coffee? Do you drive 3 miles out of your way to save 2 dimes? Of course not. You pay it. That tiny, almost invisible price increase flows directly to the company's bottom line as pure profit. Multiply that by millions of customers every single day, and you have a compounding machine. Another hidden moat is high switching costs. If a company makes a product that is so embedded in a customer's daily life or business operations that removing it would cause absolute chaos, that customer is trapped in the best way possible. They will keep paying month after month, year after year. That is recurring revenue in its purest, most durable form. But here lies the ultimate paradox. Even when you find a company with a great product, a boring name, and an incredible economic moat, there is one single mistake that can destroy everything. It is the fatal trap that traps thousands of unsuspecting investors every year. The growth trap. Imagine a fantastic local restaurant. The food is incredible, the service is fast, and the margins are huge. The owner decides to expand rapidly, opening 50 new locations a year across the country. On paper, it looks like aggressive, exciting growth. But beneath the surface, the company is taking on massive debt, the quality begins to slip, and the unique magic that made the original location so profitable gets diluted. Peter Lynch warned about this obsessively. Growth for the sake of growth is toxic. True wealth is created when a business grows within its means, expanding steadily out of its own profits, without relying on dangerous debt or wild financial engineering. When you find a company like that, a simple, easy-to-understand business, with strong margins, low debt, a durable moat, and plenty of room to expand, you aren't just looking at a stock. You are looking at what Lynch famously named a 10-bagger. A stock that pays you 10 times your original investment. Think about what a 10-bagger actually does to your life. If you put a small portion of your savings into 10 different simple businesses, and 8 of them do just okay, one loses money, but one single company becomes a 10-bagger. Your entire financial trajectory changes forever. The power of a single massive winner completely drowns out all your small mistakes. That is the asymmetric secret of long-term business investing. You can only lose what you put in, but your upside is literally unlimited. So, how do you start applying this mental framework to your own life today? It begins by changing how you interact with the world around you.